Most traders believe that the market hides its secrets in the tiny moves, the minute-by-minute flickers that seem to promise fortune if only a man watches closely enough. I learned the hard way that the market does not whisper its plans in noise. It speaks through structure, and structure is revealed only when you study it across more than one time frame. The market lives on several planes at once, and the trader who fixates on a single chart walks blind into a battlefield he does not understand. If a man wants to last, he must learn to step back, zoom in, and see the market through multiple lenses. There was a time when I thought speed gave advantage. I chased every fluctuation, thinking small waves held meaning. The more I stared, the more convinced I became that action existed everywhere. But the market also taught another lesson. The faster the observation, the deeper the confusion. Every minor pullback felt like reversal, every spike like climax. Emotion replaced reason, fear replaced objectivity. I was reacting to movements that meant nothing in the grand scheme, wasting ammunition before the real battle began. It wasn't until I paired my short-term observations with the broader sweep of the higher time frame that clarity appeared. The higher time frame is the map. The lower time frame is the street view. A man who trades without the map gets lost in the alleys. He might find luck on occasion, but luck is not survival, and survival is not mastery. When I first began respecting the broader trend, everything changed. Suddenly, the intraday movements weren't mysterious anymore. Their erratic behavior fell into place as small ripples inside a larger tide. I stopped fighting currents I didn't see and began aligning myself with direction that was already dominant. The market will always test the trader who trades against the larger tide. Resistance, pullbacks, reversals, all of them feel sharper, more punishing. But when you trade with the tide, the market carries you forward even through imperfect execution. I maintain that every trader should begin with the highest time frame he intends to respect. Daily, weekly, sometimes even monthly, depending on the style. That time frame reveals the character of the market, whether it is trending, consolidating, reversing, or simply coiling as it waits for a catalyst. If that larger chart is unclear, all smaller charts become traps. When the higher time frame conflicts with the lower one, the market grows wild. The wise trader stands aside in that confusion, letting amateurs donate capital while he waits for structure to align. From the higher time frame, one moves down deliberately, not emotionally. The next level isn't chosen because the trader wants more action, but because he needs more detail to refine the broader idea. The middle time frame shows what the larger direction looks like in formation. It is the bridge between tide and wave. It reveals breakouts beginning, reversals forming, trends strengthening or fading. This is where most professional execution happens, not blind entry, but confirmed participation. I often use the daily to map my zones, then the 4-hour or 1 hour to plan my strike. If the structure supported my thesis, I acted. If it contradicted, I walked away, no matter how tempting the lower noise appeared. When the market aligns across multiple time frames, higher showing direction, middle showing structure, lower timing execution, the trader stands in the sweet spot few ever reach. That alignment is a privilege earned through observation, patience, and restraint. It is rare, but when it appears, risk becomes smaller and potential becomes larger. Most traders lose not because they misread a pattern, but because they trade patterns that contradict the larger flow. They do not see higher resistance overhead. They do not notice trend exhaustion on the broader scale. They focus on a short-term breakout that is nothing but a wick on the bigger candle. Blindness across time frames is a costly affliction. But it was the lower time frame that taught me humility. It exposed every flaw in my discipline. It mocked hesitation, punished fear, and rewarded recklessness only to betray me moments later. The lower time frame is a weapon, precise and powerful, but dangerous in untrained hands. It is where the trader executes, not where he thinks. When I used it as a planning tool, it misled me. When I used it as a sniper scope inside the broader plan, it made me formidable. There's a difference between using the lower time frame to anticipate and using it to confirm. Anticipation belongs to gamblers. Confirmation belongs to professionals. Every time frame has a role. The larger sets your bias. The middle defines your structure. The small gives you entry and exit. Ignore any one, and your vision becomes distorted. A trader using only the large time frame moves too slowly, entering once the move has matured and often exiting too late. A trader using only the lower charts acts too fast, jumping without context or anchoring. The one who ties them together survives confusion and exploits clarity. The market itself moves across time frames like a living creature. Trends are born small, tested on the middle, and confirmed on the high. Reversals begin with fractures on the lower charts long before the masses see them on the higher candles. But waiting for confirmation across all levels keeps the trader aligned with truth rather than seduced by instinct. My greatest losses came when I allowed a lower time frame signal to override a larger trend. I thought I saw genius in a micro-reversal and ignored the roaring current behind it. The current always wins. The market does not allow traders to win by accident for long. Multiple time frame mastery is more than technical alignment. It is emotional regulation. The higher time frame breeds patience because it moves slowly. It turns the trader from a reactor into a planner. The middle time frame turns guessing into projecting. The lower time frame becomes execution without fear. When these three mental postures blend, trading becomes rhythm instead of chaos. The trader waits for alignment the way a hunter waits for the wind to settle. He does not chase because chasing reveals need, and need is death in the market. I began to treat time frames like generals, officers, and soldiers. The general sets the direction. The officers organize the plan. The soldiers carry it out. If the soldiers charge without command, they die. If the general never gives orders, nothing is accomplished. The chain of command must be respected. The greatest discipline I ever learned was refusing to take trades just because the lower time frame invited me. Temptation on the 1-minute or 5-minute chart is constant. Those movements appeal to the impatient trader, the one who thinks he can outmaneuver risk through activity. But activity is not progress. Only alignment creates advantage. A professional can sit with a chart for hours, even days, waiting for the trifecta: direction, structure, opportunity. Until all three appear across multiple time frames, he is content with stillness. Beginners fear stillness. They confuse patience with laziness, inactivity with failure. They crave motion because motion feels like purpose, but the market is cruelest to those who cannot wait. It draws them in with promise only to shake them out repeatedly until they realize the only move worth making is the one aligned with the broader tide. Understanding multiple time frames also protects a trader from emotional whiplash. If you trade only the lower chart, every candle feels personal. Gains excite, losses sting, and the trader becomes an emotional puppet. But when you anchor yourself in the higher time frame, those same small moves shrink into insignificance. That emotional distance becomes a weapon. You cannot be manipulated by noise when you recognize it as noise. I once traded against my higher time frame bias because the lower chart looked irresistible. The move felt clean, the momentum strong. It worked for a while. Then the market snapped back in line with the larger trend and erased every gain, plus more. That experience taught me a rule that saved me countless times. The higher time frame never apologizes for crushing the lower one. If there is conflict, the larger view prevails with ruthless indifference. You obey it or you bleed. Multiple time frames also teach context. A failed breakout on the lower chart may simply be a retest on the higher. A trendline break on the 1 hour might be meaningless noise inside a weekly uptrend. Without context, every move has too much meaning. With context, only a few matter, and those few are your edge. Mastering multiple time frames is not about complexity. It is about clarity. It is about seeing the market as layers of truth rather than a single flicker of deception. It is about knowing when to act, when to wait, when to hold, and when to exit, not based on emotion, but based on alignment. But the most dangerous moment in any trading career is not when you are losing. It is when you start winning and convince yourself that you earned the right to be sloppy. A few victories stack up. You catch the 1-hour entry perfectly. You ride the 4-hour trend. You add size and watch your account swell. Before long, your mind whispers a poison. I've heard more times than I can count. You figured it out. You're ahead of the market now. You deserve more. That whisper turns great traders into gamblers overnight. Because once you believe you're smarter than the market, you stop doing the work that got you paid. You ignore the daily structure because the 1 hour looks juicy. You stop waiting for confirmation on multiple time frames and jump in early. You abandon risk limits. You convince yourself that the next push is guaranteed to keep running because the last one did. One day, you wake up and the account is gone, vanished the exact way it was earned, slowly at first, then all at once. A trader's job is not to conquer the market. The job is to survive long enough to align yourself with the rare periods when conditions favor your method. But survival is only possible when you build your entire system on the foundation of discipline. And no discipline is more powerful than requiring multiple time frames to agree before you act. Let me put this plainly. Every time you take a trade without waiting for a higher time frame confirmation, you are stepping into the dark with a lit match, hoping there's no gasoline around your feet. Maybe you get lucky, but luck is a loan, and the market always collects, with interest. When I traded my biggest campaigns, I learned to see price not as a collection of bars and patterns, but as a living narrative. The daily chart told me the theme. The 4 hour organized the plot. And the 1 hour, that was where the characters made decisions. Every winning position I ever held was first a story I understood before a trade I executed. If the daily story changed, all my smaller decisions were invalid. I'd exit positions that were profitable because the larger tide was turning against them. I'd hold trades through temporary heat if the higher time frame remained favorable. The average trader does the exact opposite. They hold losing trades, hoping the daily trend will magically rescue them and sell winning trades because they fear a pullback. This error repeats until they have nothing left to repeat with. When you master multiple time frames, pullbacks stop looking like danger. They become opportunity. A trader watching only the 1 hour chart sees a retracement as a threat. A trader aligned with the daily and 4 hour sees it as fuel. You begin to understand that a trend grows stronger as weak hands are forced out. You stop reacting to noise because your conviction isn't coming from the last 10 bars. It's coming from structural clarity. But let me speak honestly here. Mastering multiple time frames will not protect you from losses. Nothing will. The market will always find a way to remind you that you are not in control. What it does protect you from is chaos. It gives you a reason not to trade when conditions are muddy. It forces you into fewer, higher quality opportunities. Most traders' problem is not that they pick the wrong trades. It is that they take too many trades and dilute their edge until it disappears. Patience is your real leverage. When the daily is trending, the 4 hour is aligned, and the 1 hour gives you a clean entry. That is when you increase your size. Not because you are confident, but because you are prepared. Confidence without structure is delusion. Confidence with confluence is solvency. There were days I sat in front of the ticker tape and did nothing. Hours passed without a single trade. Early in my career, I hated those days. They felt like wasted time, missed opportunity. Later, I realized they were the most valuable part of the job. Doing nothing when nothing should be done is the hardest skill in speculation. The market rewards restraint ruthlessly. When your conditions return, you strike like a patient cat, not a frantic dog chasing every thrown stick. Now, let's talk about exits, the most neglected part of multi-timeframe strategy. The 1 hour gives you the signal to enter. The 4 hour shows you how long momentum should reasonably last. But the daily tells you when the environment is ending. If you insist on exiting based purely on profit or fear, you betray the system you worked to build. The chart already knows when your trade is done. Price fails to make higher highs. Momentum falters across time frames. Structure turns. These are messages every trader hears, but only the disciplined obey. The irony is that the biggest mistake traders make with multiple time frames is not failing to read them. It is refusing to act when the data contradicts their beliefs. You will see a trend weakening, but talk yourself out of closing the trade. You will see a major time frame flip, but convince yourself it is temporary. You will see a perfect setup align but refuse to take it because the last three trades were losers. That is not a chart problem. That is a human problem. The market is designed to test humanity. It tests your courage when the setup is clear, but fear tries to hold you back. It tests your discipline when excitement pushes you toward shortcuts. It tests your memory by rewarding you one day for breaking rules, making the next temptation louder. And then later it punishes you twice as hard for forgetting what kept you safe. I learned again and again that success in speculation is not about intelligence. It is about self-control in the presence of uncertainty. A man can read charts better than anyone alive, but if he cannot control himself when price moves against him, he is unfit for this profession. And the only thing that gives a trader control is a written plan rooted in multiple time frame agreement. Write your rules. When do you buy? When do you add? When do you exit? Which time frames must agree? What invalidates a setup? And once written, treat them like the laws of nature. Break them only if you no longer desire to remain solvent. There is one more truth I've seen ruin many ambitious traders. They see the power of this approach and assume they can master it quickly. They jump back and forth between time frames, trying to force meaning into random price movements. They spend hours watching candles change, waiting for drastic events that never come. But understanding comes slowly. First, you will see the time frames independently. Then, you will start to recognize their relationships. Only after many repetitions will you feel them move as one. Think of it like playing a piano. Anyone can hit keys. But to play well requires muscle memory, timing, and the ability to hear when a note is off. And when you do finally hear it, trading becomes quieter. Your decisions shrink. Your charts simplify. You execute less but profit more. One day, you will take a trade that follows your rules across all time frames, and the market will still stop you out. You will feel a familiar frustration rising, but instead of chasing it, you will shrug. Because you will know something most traders never learn. A losing trade that follows a disciplined plan is a victory. It keeps you in the game long enough for the fat pitch. It clears your mind. It keeps your capital liquid. And it ensures that the next time the daily, 4-hour, and 1-hour align in your favor, you will be ready, funded, and calm. Speculation is a lifetime lesson with no graduating class. The market will humble you when you least expect it. It will test you when you are tired. It will tempt you when you are strong. But if you let the larger time frames guide the smaller ones, if you allow structure to define opportunity instead of emotion, you will find something rare in this business, a system that protects you from yourself. And when that happens, everything changes. You stop chasing, you start waiting, you stop guessing, you start aligning, and each move you make becomes deliberate, logical, and suited not for the anxious trader you once were, but for the operator you are becoming. That is the path. Not to perfection, because the market grants that to no one, but to consistency, to understanding, to survival. And survival long enough in this arena becomes success, because the market eventually rewards those who can stay in the ring without destroying themselves. Keep your eyes on the structure. Let the time frame speak in order. The daily sets the wind, the 4-hour fills the sails, and the 1-hour steers the ship. Sail that way, and the storms you once feared will become the currents that carry you exactly where you meant to go.